Okay. Going on to another stock, British company, FTSE quoted, London quoted company, Rio Tinto. Today, it's exactly the opposite. It was the biggest mover for most of the session. It was up 3-4% different moments of the day. In theory, it's very geared towards the price of iron ore, which in turn is very much dependent on Chinese demand. In theory, the Chinese economy, as far as exports, manufacturing, in theory, we're not at the peak of the cycle. The economy is supposedly slowing down, yet, for example, we do have data out in the last couple of weeks showing that the number of Cape-sized vessels transporting iron ore, 90% of them are headed towards China. The new ships which have been contracted, I believe the number has increased by 50% in September. So it seems like the Chinese are stocking up on iron ore. Is that sustainable? Is it inventory? What's behind that? Rio perhaps might be due for a bounce if China's present on the upside?
Yeah, the production figures today were better than expected, and that's resulted in a 3 to 4% gain in the share price today. On fundamentals, Rio is relatively cheap. It's less than half of the level where it was a few years ago, trading just above £30. Again, we have to see what happens in China. If there is even a little bit of growth, it's obviously good for diversified miners like Rio Tinto. On valuation grounds, Rio is on a single PE ratio, so that obviously sounds out that a lot of bad news is factored into the share price.
So today we're seeing a little bit of short covering?
So yes, short covering and a possible bounce, but again, a lot depends on Chinese economic growth figures and whether that is sustainable.
Okay.
They still need to build their roads.
Definitely, they have many of those to build yet.
And also, it's not just China, I guess. It's look at the rest of Southeast Asia and some of the other emerging markets. India too has a massive infrastructure problem, which needs to be rectified, and these mining companies are going to be at the beneficiary level of that.
Okay. Zach?
I'm probably actually more bullish on mining stocks, or the larger ones like Rio, and probably I think that that they've been so bombed out that even if China is not doing what it's supposed to be doing, that is factored in. So for Rio, anywhere at or near £30 a share, it's got to be, I think it's got to be attractive to sort of bargain hunters.
So not short selling.
So I think it's a buy situation, but I would actually be probably more bullish on that, despite the fundamentals.
Fantastic. Okay, one more stock. You can hear a lot about Royal Mail in the last couple of days. Some people say it might have a little bit further to go. Some people say it's completely overvalued. A couple of months ago, some analysts were telling me that really the company does not have much of a future. It's falling behind the curve in a very big way. So unless it truly changes all of its processes, catches up with some of the more modern competitors, if people are pricing that in, perhaps. But do you believe that the recent rise after its stock market debut is justified, or is it time to sell?
It was obviously priced to sell at 330 pence, and it's now very close to the 500p level. I don't think many people expected it to have that kind of premium. It's gone up 50% from the flotation price. Was the family silver sold too cheaply? I think at the moment the rally seems to be somewhat a little extended. There could be some profit taking, but again, it's giving an attractive dividend yield in this low interest rate environment. I think when it was floated, it was above 6%. Now it's probably down to just above 4%. It's still, it's probably it's got good value. It's making decent profits, but the valuation seems to be a little bit overstretched.
There is huge institutional interest.
Yeah, there is, but more at 330 rather than at 500 pence or close to.
Okay. Zach?
I think it's a great way to buy votes. That's the first point to be made. The issue of valuation, obviously there was going to be a situation if it was like this scenario, it's too cheap. If it had been the other scenario, people would be crying, as they did with Facebook. So in our sort of media, we only have one or the other extreme, and there's no other way of looking at these things. So I think it's better that it was flogged at a cheap price. The 6% dividend yield was never going to be it was never going to stay at a 6% dividend yield anyway. I mean, probably 3 to 4%. You probably judge it by that, really, that 3 to 4% is whatever value share, £5 a share, whatever it is. So I think the whole thing has been a massive success, and it's been a long time, a lot of pent-up demand, and people, apart from putting their money into houses, they've had an opportunity to be little entrepreneurs again after a long time.
For a retail investor who might have purchased it, would you say stay in for the long haul or take some profits, take some money off the table?
I'll be staying in for the long haul. I think it was sold too cheaply, as it turned out. But I think it's a bargain. I don't think there's any reason to get out there.
However, Kazanov, I believe, is going to have to give an explanation. What is it for which committee is it that they're coming up against?
Probably House of Commons
House
policy, Treasury. But that's normally a more promotional exercise. They never do anything. They just have their afternoon in front of the cameras, and everybody remembers the name of Kazanov and probably forgets what they're there for. But I don't think there's anything to be ashamed of or upset about. Everybody's won on that.
Right.
The government's got $3 billion or whatever they've got in there, and all the private investors are happy. So I don't think there's anything to moan about there.
So in the end, people are always happy with financial markets as long as they go your way.
I think it's good as well. I mean, it's just also something that maybe it'll bring some people back to the stock market for other situations to invest again, because the retail investor has been away from the market for a long time. So I think it's great.
That is an interesting point. Do you think retail investors, most retail investors are, and not just in the UK, everywhere, are very skeptical about the long-term potential of shares of the stock market? Do you think that might be changing?
I think that, as Zach just said, that with the Royal Mail success, that will hopefully entice more people back into the market, especially when savings rates are so low. There aren't many other avenues or asset classes where one can invest, or where one can invest, but compared to just putting your money in the bank and getting 0.5% or 1% or whatever the savings rate is, coming back into equities, buying some of these high dividend yielding shares is a good long-term attractive proposition.
Okay. One last question, oil. There's a lot of instability in the Middle East, and Brent is at $110 per barrel heading into the winter in the Northern Hemisphere. That's not too high. If we got a clean resolution to the standoff in Iran, people are saying you could see this morning they were saying $10, $12 to the downside in the middle of the winter demand in spring, right after the New Year's. I would imagine if it follows the typical seasonal pattern, it could fall even further. It could give a small boost to economic activity everywhere. What are your expectations for the oil price? There does seem to be, we're in a situation where you also have supply disruptions in Nigeria, in Iraq not so much, in Libya, and well, in Iran you have quite a bit of production off. If that ever came back online, you would see a very swift and large drop in oil prices. That's something we haven't seen in many years as far as the big macro picture is concerned. Do you think there's a story there? Where do you see oil price going in the next couple of months?
I think the story is probably that around $102 on WTI. It is looking at the lower end of the range. From my technical perspective, I don't expect it to fall much below that. I mean, let's just say $100 is the lowest there.
Okay. What time horizon?
Just, I mean, I would be a buyer now, and I'd be a buyer of, let's say oil stocks on that basis. But I think that it's got a bit too low, and there's a lot of chaos in there. They've papered over the cracks in the Middle East, and you've got the shutdown maybe giving it a negative spin. But again, a resolution to the shutdown or a fudge or whatever we're going to have should, just because I think oil's just basically in sort of it's a shutdown mode itself at the moment, just waiting and seeing.
Right.
But this is my buying zone from the charting perspective. So how the other factors pan out, we have to see.
Okay. Ronnie?
I think that obviously, as Zach again just said, that those paper cracks have been filled in the Middle East. Geopolitical concern is still very much of the essence, and we still don't know what's going to happen in Syria. Pipelines being disrupted, the Iranian situation, the whole region. So if oil does fall back a little bit, I'd certainly use that as a buying opportunity. The Middle East is still one big volcano.
Okay, not very good news. Okay, unfortunately, gentlemen, that's all the time that we have for today. But we do hope that you will join us again next week and hopefully give us a little bit more time, if possible.
Thanks.
Sure, thank you.
Thank you very much. And that's all from us here at Digital Look TV in London. Thank you for joining us, and until next week.